USD numbers, sorry. But yeah, all signs are pointing to a slowdown for October that is supported by the manufacturing weakness that we've seen from the PMI readings. And also, analysts have been expected a slowdown because of the week-long holiday with Golden Week, but also the unfavorable base effect a year ago when manufacturers were anticipating further tariff hikes ahead of the Trump White House. But now we have those October numbers coming in for exports. They have fallen 1.1% year on year. That is far missing the estimate of a slowdown of a rise by 3%, and imports, on the other hand, have risen 1.1%. That is also down from the 3.2% that was forecast for imports. So this is really highlighting the weakness in domestic demand, but also the sharp miss with the estimates in exports, really as asking questions about the strength and the resilience of China's exports. And analysts have been sounding a cautious note, pointing to a decline in October's new export orders, because previously the strength of China's exports has been supported by a lot of trade diversions to non-U.S. markets when they were faced with the threat of U.S. tariffs, and also a strength comes from being entrenched in the global supply chains, China being a major supplier of these intermediate products. But these advantages could be starting to wane. And also Chinese exporters, according to HSBC, has been selling more to other markets at the expense of their profit margins. So this is also a potentially concerning trend for profitability, and continues to highlight the involution problem that China has. But this we've got the tactical truce reached by President Trump and President Xi. So that hasn't been reflected in these October numbers yet, as the truce was reached on the last day of October. But this could be more cause for concern in terms of having that material recovery, and also it's a continued manufacturing weakness that we've been seeing for months now. So this also, there is that unfavorable base effect, of course, but this big miss is a bit of a surprise, and is something that will keep policy makers in Beijing concerned about its export-oriented economy as well. Manisha.
Yes, very much. Elaine, thank you for jumping on that so quickly for us. Elaine, you there in Hong Kong, updating us on those China trade numbers, which are hitting the wires as we speak. Now, the Indian markets will come online soon, so let's get a look at what GIFT Nifty futures are indicating. We're looking at a negative start for the session. This is after, or negative to flat. This is after the Nifty fell way behind that 26,000 level that it had been moving in and out of, but not managing to find support with over the last month or so. And some of that tech sell-off was reflected in trade for the Nifty yesterday. This is when markets opened after a holiday. The Nifty continued its pattern of lower highs and lower lows. Some of the big companies dragging the Nifty down after weaker earnings reports cards also. So we're going to talk a bit more about that later in the program. On the trade front, the US President Donald Trump is saying that he would visit India, with talks progressing well.
Going good. He largely stopped buying oil from Russia.
When do you plan?
And he's a friend of mine, and we speak, and he wants me to go there, and we'll figure that out. I'll go. I had a great trip there with Prime Minister Modi. He's a great man, and I'll be going. Yeah.
Planning to go to India next year, sir?
It could be, yeah.
That was US President Donald Trump talking about when he might go to India. The comments are yet another indication of a thaw in the India-US relationship, something that has been strained ever since Trump slapped 50% tariffs on India's exports, the highest in the world. Negotiations between the two sides do continue, but little in material detail has actually emerged about the status of the talks in the past few weeks. Trump has not visited India since February of 2020, a month before the pandemic hit. But his ambassador to India, Sergio Gore, was in the country last month and met the Prime Minister, Narendra Modi. Meanwhile, officials in the Indian government appear to downplay the significance of any potential intervention from the US Supreme Court. Earlier this week, the US Supreme Court expressed skepticism around Trump's constitutional powers to impose tariffs. Indian officials told Bloomberg that a Supreme Court ruling against Trump won't make much difference to the trade talks because the White House has other options. However, the potential court action could prompt Indian negotiators to push for language that's compatible with WTO rules and would be legally binding. One official said a ruling against Trump would strengthen New Delhi's case for sticking to its position. India's Commerce Ministry didn't immediately respond to CNBC's request for comment. In the meantime, India could soon see bigger banks. Finance Minister Nirmala Sitharaman has said that the government is working with the Reserve Bank of India on creating more world-class lenders, and fresh consolidation among state-run banks is also on the table. India currently has 12 public sector banks holding 55% of the country's banking assets after a major merger exercise back in 2020. The government is also weighing higher foreign investment limits in state-owned banks to help scale them up. Sitharaman said work has begun, but stressed the need for a more dynamic ecosystem to support larger banks. There's also lots of IPO activity in the market today. We're watching fintech firm Pine Labs, who we had on the show recently, as its $440 million IPO opens for retail subscriptions today. Ahead of that launch, the company locked in over $197 million from anchor investors. The IPO is a mix of fresh shares and an offer for sale, with 75% reserved for institutional investors, 15% for non-institutional, and 10% for retail buyers. It's a significantly scaled-back listing, but it could still net a valuation of up to $2.9 billion. Meantime, the $754 million IPO of Grow's parent, Billion Brains Garage Ventures, was fully subscribed on day 2, driven mainly by retail investor demand. It ended the second day with overall 1.64 times subscriptions. Retail investors bid for over 5 times the shares reserved for them, while non-institutional buyers subscribed 2.26 times. Grow is shaping up to be one of this year's biggest IPOs in India, alongside Tata Capital, LG Electronics India, and HDB Financial. Well, Feroz Aziz is Deputy CEO at Anand Rathi Wealth. He joins me now. Really good to see you, Feroz. Let's first of all talk about the IPO scene right now. Finally, Pine Labs has done it. It's coming to market. And it wouldn't be drawn all year in questions by journalists about when this was going to happen, how this was going to happen, what it was going to look like. But finally, we have some information. So just give us your review on what you think so far.
I think, yes, this IPO has been awaited. One is, I think the IPO market is reasonably vibrant. So I personally think that the set of investors who invest in the IPO and subsequently the volumes which we see after listing in an IPO, almost the kind of free float which is infused in the market gets traded on the first day in most IPOs. So point I'm trying to make is an IPO has 2 stages of life. One is the collection from the primary market. And once the primary market is shot and then the listing happens, IPOs in India, if you see the volumes in the first 4 or 5 days, you would see at least 3 times turnover of the large portion of free float which is provided to the market. So I think one is all the companies, how they do in the first stage of the first 1-2 weeks is one part of the story. The second part of the story, most IPOs which hold up their IPO prices, and there are some technical resistances in the IPO. One, if one could spot after listing an IPO, is easier to spot, point 1. Point 2, if they don't fall 5-7% lower than the IPO price, then the kind of stage which is set for further progress is significant. So one, of course, Pine Labs has been awaited for long periods of time. Second, I see the life of a company after getting listed and after the whole shareholder turmoil is done and dusted, and what kind of base formation, what kind of shareholder ownership comes, and which kind of ownership is there from the FII and DII side, which gets published on Bloomberg, is what we see to see what has a long-term future rather than a short-term trading opportunity.
So Feroz, of the big IPOs that we've seen in the last couple of months, which are the ones that you have been particularly interested in, just in terms of what that trajectory was like, given the initial offering and then the pricing within those first few days, and then what happened after that? I mean, Tata Capital was a big one, right?
Yes, Tata Capital was a big one. I'm not qualified to comment on stocks, but I can definitely give you a little theme of how an unlisted stock. Tata Capital was a very different, unique kind of a IPO. Why? Because in the unlisted space, you would see Tata Capital quoting at prices almost 3 times actually the IPO price, where Tata Capital went into the market. So what happened was it was a very popular unlisted share for the last few years, and a lot of people who had bought that share in the unlisted space lost money. Anybody who owns a share before it gets listed is locked in for almost 6 months to a year. So Tata Capital was a very large disappointment, at least for the unlisted investor, and that had become a deemed public company. So that's point 2. Point 3, I think, which are the other IPOs which are interesting? Of course, there are some IPOs which were loss-making companies or technology companies which made a lot of news in the marketplace. But what is very interesting to see in the IPO market from a retail investor's or an individual investor's perspective is most individuals and retail participants are following the anchor book. If it's very well subscribed on the anchor side, the retail subscription is near certainty. And what is happening is the anchor book is getting oversubscribed significantly because of the kind of cash the domestic institution is sitting on. So anchor book resulting in retail money going into domestic institutions, resulting in anchor book. That's the kind of vicious cycle which is promoting the kind of subscriptions which we are seeing in the IPO market. And I would say it's on the little overheated side.
Oh, that's interesting. So would you say that that is one of the ways in which 2024 has been different to 2025?
Yes, it has been different. And I think that's the need of the hour. If you look at the Indian capital markets, we have 140 billion people, or 1.4 billion people, and the kind of free float which is there in the market. NSE 500, the 500 stock has a free float of not even $500 million. The total free float of all the 524 stocks in the MSCI small cap index is 34 trillion rupees. And domestic institutions are expected to infuse almost 50 trillion rupees over the next 7 years. So there is little free float. So I would say what is happening today is one of the best things which could happen to avoid a bubble or a valuation exaggeration. Because if there's no good paper in the market, how will it absorb the entire financialization? India has only 6.7% of the household savings in equity. Most of the other countries have 20-25%. So India has a long way to go. That kind of influx from debt to equity will result in pockets of overvaluation. If that has to be avoided, good paper needs to come into the market well in time so that our indices have enough free float to absorb the kind of financialization India has to do over the next 10 years.
Yeah, absolutely. I mean, you're talking about over the next 10 years. There's a lot of evolution yet to go through, and you've got to get to that stage where it becomes this sophisticated market. India's market regulator is going to consult stakeholders to review IPOs of small firms. What are your reflections about that?
Yes, I think the small firms, the fact that the IPO law rules have changed, the amount of free float needed to go IPO has come down significant. The dilution, requirement for dilution has come down, one. Second, I think India has a very sweet spot. I would say any company which is almost $250 million should look at an IPO, and that's what Indian promoters are doing. I was in an event where there were almost 200 top private families who run businesses who are looking at listing or private equity, and most people are gravitating towards the public life of listing rather than private equity. That was a huge shift I saw over the last 5-7 years in the Indian promoter mindset, which are either our clients or Indian families who own businesses who need to dilute. So I personally think SEBI promoting smaller businesses to get listed will create a larger tail of good businesses which are low. In India, India has the largest number of listed stocks in the world. But the unfortunate part is there are two sides to the story. There's one side of businesses which are absorbing a large amount of capital. There are other businesses which are grappling for it. I think this whole two ends will meet somewhere in the next 4 years.
Okay, we're going to switch gears now. Let's talk earnings. What do you think have been the highlights and the lowlights of the earnings season so far?
See, I personally think when it comes to earnings, India's second quarter earnings, if you look at 28, 29 Nifty companies which have finished their earnings, have grew just about 4% year on year, same quarter, point one. Point two, how we look at each quarter is what is the odds that the year target will be met. Our year target for Nifty growth is 11% earnings growth. I think that seems to be getting more solidified than weakened. So I would say the 11% growth on a base of 1,176 rupees, which is what was the earnings for Nifty last year, seems to be a very high probability. Point one. Point two, what is interesting is going to be to see what's the small cap earnings, NSE small cap 250, which is the index which all domestic institutions are mandated to track, has 250 stocks. 93 stocks have finished their earnings, and the earnings growth pleasantly has come to 17% for these 93 stocks. Last year, the earnings growth for these 250 stocks was 18%. If you don't assume a change of 63 stocks every year, these stocks change. If I keep a constant constituent model to evaluate the last year earnings, it was 17%. I think on the back of last year's 16, 17%, another 16, 17% will be a good thing to solidify the market and not create any underperformance of the broader market to Nifty.
Okay, but you know, it's really interesting. The last month or so, the Nifty was trying to push and find support above 26,000 and not actually getting there. So it's going to be interesting to see where the market opens this session, especially since we have such downward pressure coming in terms of the messaging from the United States. Let's get into the macro picture. What are some of the external influences? GST, let's just cover that for a second. And from a macro standpoint on the overall economy, talks around tariffs, for example, how is all of this playing into sentiment?
Yes, so if I break this down, if you look at GST, if I take GST first, GST growth for the first 6 months is about 9%. That's a good growth. Now comes the GST cuts, which will show up in the next 2, 3, 4 months, both in the terms of the domestic demand going up and the GST collections falling marginally over the short term. If you look at the direct tax collection, the July numbers have had some dip. There was an extension in terms of the due dates to file people's returns. I would attribute that dip completely to this delay or the extension of the due dates. Point two. Point three, I think we've penetrated 36% into our fiscal deficit target for the year, which I think is in line. So we're going to be fiscally prudent. If you look at the kind of non-tax collection, which the government had budgeted, we are almost 90% thanks to the dividend from RBI. So I personally think the macro, especially on the inflation side, has also been very positive. That implies that there's further significant headroom for an Indian central bank vis-a-vis the Fed to reduce interest rates. And already, if you see that the short end of the yield curve has come down, there was a flattish yield curve for the last 3 years, which India was not used to. That was putting immense pressure on the deposits of the banking system. Once the yield curve again gets upward sloping, you will see the banking system not grappling for deposits, because Indian investor, especially the depositor, is very used to a higher interest rate motivation for a longer period deposit. So I think, so the whole yield curve bit, the inflation bit, GST, the tax collection, non-tax revenues, the fiscal prudence, all this put together creates a good domestic macro environment. But the global macro environment has been bad. In that environment, if India has been able to sustain 3-4% lower than its historical levels of last year in September, I think it's commendable. And if there's some good news on the global side, you will see all kind of short covering, especially in index futures, which FIIs are almost 84% short in index futures. They're short practically in the cash market. They've been selling. Domestic institutions are sitting on cash. So any kind of good news could infuse some degree of short covering. The fact that we are at 25,500, given the kind of global environment and the kind of tariff threats which India has been sidelined, and our competitors in the global market, Bangladesh, Vietnam, are enjoying a 15-18% tariff, and we are 25 plus 25. That's a scary thing. In spite of that, sticking at 25,500 is more optimistic than pessimistic, I would say.
Feroz, just finally, thank you, and thank you for covering all of that. It was a multi-layered question. My last question is really around, why would investors be looking at emerging markets right now? Why would they be looking at Indian equities right now when yields are actually looking better elsewhere? If you look at bonds, if you look at gold, if you look at, treasuries, for example.
See, I think I personally think it's all about the time frames. If somebody is looking at something as short term as 6 months to a year, definitely there's no case for emerging markets. There's enough opportunity globally, or in the commodity space or the precious metal space, as you lightly alluded to. But if you're looking at 3, 4, 5 years, you have to chase growth as an investor. And where is growth? Growth is clearly in the economy side in India, right? A large economy like India growing at that pace and promising to grow for the next 5 years on the nominal side more than 10% is a very good raw material for one to create a portfolio to beat 15, 17%, even dollar return. So I personally think if growth is there, if an investor is a 5-year investor, there's no other choice he has but to chase growth. And growth is highest probability in India, in the large economies, in the last 6, 7 economies. Growth is there. That gives you a great raw material for a good bottom-up stock picker to get to 15, 17% dollar return in emerging markets, or especially India. I think that's a reasonable case to be attracted.
All right, Feroz, thank you so much for that. Feroz Aziz from Anand Rathi Wealth, thank you for handling all of those different angles for us. All right, coming up, global capability centers in India are leading to a real estate boom. And they're also not just back offices anymore. So we're going to ask what's driving the change. That after this short break. Welcome back. You're watching Inside India. It's with me, Manisha Tank. We are counting down to the market open in India, and this is how things are shaping up. GIFT Nifty futures pointing to a weaker start, very much picking up the baton from other Asian markets, which have all been in the red this session. The Nikkei, for example, down more than 2.2%. This after also a weaker finish on Wall Street overnight. And so we are expecting an open that will be below yesterday's close of 25,509. The Nifty not finding support anywhere near 26,000. Elsewhere in the news, despite President Trump's push to hire more locally, American and global companies are doubling down on Indian talent, and they're not even asking them to relocate. A new report by ANSR, a firm which specializes in global capability centers, or GCCs, shows a surge in GCCs in India over the past 3 years. ANSR says over 2/3 of the Fortune Global 30 and 174 of the Fortune 500 now run these centers out of India. Why? Skilled talent, cost efficiency, and a maturing hybrid work culture. And these aren't just back office roles anymore. Companies are hiring for leadership and strategic positions as well. And all of this is fueling a commercial real estate boom. So here's what the CEO of Mindspace REIT, Ramesh Nair, told us.
Today we have 1,900 GCCs in India. That they occupy close to 280 million square feet. This 280 million square feet is expected to go to 540 million square feet. If you look at the cost of setting up a GCC in India versus the cost of setting it up in the US, we're talking of 20% cost. So it costs, if it's $100 in the US, it costs $20. Let's look at a worst case scenario if the HIRE Act comes into play. That $20 could become $24 or $23. So India's cost benefit in terms of low cost of talent, which is 1/10, low cost of real estate, which is 1/8, will still continue, JP.
Okay, so there's a review of why there is such interest and demand for office space in India. Sumit Saralgi is the Indian head of Oliver Wyman and can talk to us now a little bit about the hiring surge as well and what is driving demand. Sumit, it's lovely to have you on the show. Thank you so much for joining us.
Good morning, and it's lovely to be on the show.
Great. Well, let's just start, first of all, with what's driving demand. We heard a lot there about this being very much about cost, but I'm sure it's not only cost. There are many more incentives as to why there is such a surge in hiring going on at these GCCs in India.
Absolutely, Manisha. The Indian Global Capability Centers are rapidly emerging as very critical and very strategic assets for global businesses. Today, they are powering innovation and technology leadership and are driving complex business processes for many of these organizations. In some ways, the Indian GCCs are not only scaling, but are moving from cost to core because the work has shifted across multiple waves, from cost or talent arbitrage to them becoming transformation and innovation hubs that are shaping business outcomes across many of the functions, whether it's R&D, sales, customer experience, marketing, product, engineering, P&L, etc. In order for us to understand what is driving this, we often talk only about the India story, and as you rightly said about the cost and the talent arbitrage in India. But one other thing we also need to understand is what's driving the demand from the global enterprises. What are those key dimensions because of which they are actually looking at Indian GCCs? And in my mind, there are three of those. One, they are looking for strategic integration with their global businesses. They want the Indian GCCs to be closely aligned with their business priorities, to anticipate what's happening in the market and to participate in decisions. Second, they are looking for autonomous value creation so that the Indian GCCs can own the innovation pipeline, they can drive the product development, and they can drive proprietary technology development. And last but not the least, the global enterprises are looking for continuous innovation at speed. And this is what is driving the talent demand for India as well.
That's very I find it very interesting, and not to get into too much of history, but we know that at some stage, despite history, English very much became a link language for India. And I wondered about that because language is often a mark of culture. How much of that has been an integral part of why, there are GCCs in India, but perhaps in not other Asian countries?
You're right, Manisha. The GCC evolution in India has undergone multiple waves. It started with a very cost, talent, and language-driven arbitrage that India afforded. Not that that advantage has gone away. India is only strengthening in those advantages. But over time, many more layers of advantages that India has and provides to these global enterprises has actually come in. It is about the quality of the talent in India, not just the language. It is about the skill sets of people in India, the kind of technical skill sets that they bring, the kind of managerial skill sets and leadership skill sets that they bring, and the ability to work in the same breadth as the global enterprise. So I would say it's not just the language, but a lot more that Indian talent offers.
Okay, let's talk about the H-1B situation. So we know now that if you're an American firm and you want to bring in talent from overseas on an H-1B visa, you would be subject to a one-off $100,000 charge. This happened this year, but actually we're seeing this growth in demand for senior positions in India predate that. Do you think it's going to increase even more now that there are these H-1B restrictions? Has there been any connection to the hiring trend?
So let's talk about it. The growth of senior leadership hiring in India has been a trend, as you rightly said, for many years now. And it goes hand in hand with the growth of importance of the Indian GCCs today in the business operations of the global enterprises. So as they increase the number of people in the Indian GCCs, naturally, the leadership talent in India needs to go hand in hand with that. Due to the H-1B, and I've had a discussion with many GCC leaders in India, the senior hiring they only see it as a positive development because for them it basically underscores the point that the leadership for GCC has to be hired in India. The leadership for these functions and innovations that they are driving has to be hired in India. So I've not seen a lot of worry around the H-1B, sort of regime, especially from the GCC side. It will only encourage hiring of more leadership positions in India.
Okay. Interesting scenario, though, that's emerging, which is some American firms, for example, will be laying off workers perhaps at a more senior level and in middle management in the United States. But meanwhile, could also be hiring similar workers at GCCs in India. When does that become a problem? Because this is not something that the administration in the United States is going to ignore.
Absolutely. I think one needs to go into the details of, what roles are being laid off in the US, if at all they are being laid off in the US, and what roles are being hired in India. And very often we find that those are not the same roles. And so firms in the US or in any other geography are continuously innovating, continuously reimagining their organizations and in keeping up with the trends in the market. Whereas the Indian GCC talent that they are hiring is specifically for leadership in platforms, leadership in R&D, leadership in all the different processes around sales, marketing, customer experience, etc. So I do feel that these concerns are overblown in some way, and the causality may or may not exist.
Also, I think what's quite interesting is, the GCCs are obviously in different parts of the country. The infrastructure around them differs depending on which state you go to. And of course, the feeders of talent coming into the GCCs. What is the spread? Like, where are most of these centers and where is the talent coming from? And can that pipeline be assured? Because the growth expectations are pretty bullish.
You're right. A lot of the GCCs in India started out with larger tier one cities. And slowly these GCCs are now moving on the back of incentives that the governments are providing into multiple different cities as well. So today you will find GCCs getting established in smaller cities like Jaipur, Coimbatore, etc. Of course, states like Gujarat, or cities like Bangalore, Hyderabad, Pune, and many other cities continue to be magnets for GCC location. I do remember, many years back when I was trying to assist a client in trying to figure out a GCC location, the criteria was had an interesting idea about number of flights that the executives in that firm have to take in order to reach. But as you rightly said, today, two or three things have changed. The infrastructure in India, whether it's about connectivity, that has really transformed itself. Second, the talent has really sort of democratized itself across both tier one and tier two cities. So today's talent in GCCs is actually coming from both tier one and tier two cities. From colleges that are specialized colleges, engineering colleges, and other universities across India. A lot of the GCCs do tend to train the people once they hire them in their own specific processes, but they're actually happier doing that in tier two cities as well. So we'll definitely see a trend towards moving to tier two cities. Because the talent is there and the connectivity and the infrastructure is good.
Yeah. Briefly, I just wanted to drill down on those top tier GCSEs. Where would you say the biggest GCC market is right now in India, and why?
From a industry perspective, the biggest GCCs started out in the banking industry. Those GCCs tend to be in larger cities. As these GCCs have now grown, they're actually, as I was saying, shifting to other locations. But a number of things are now changing. A lot of other industries industry verticals are now coming up over the past 5 years in terms of the GCC. So you have retail and CPG companies, you have healthcare and life sciences companies, you have manufacturing companies, you have auto companies, you name it, right? Even big tech giants like Microsoft and Googles of the world, energy companies, everywhere is actually, every kind of vertical is actually trying to establish its GCCs in India. And what one might see is a bit of a concentration in certain cities. So certain cities might be might have more of life sciences or clinical trial related talent, and colleges that do that might attract GCCs closer to them. There are already established industrial hubs in India. So if there is an automotive hub, then it might attract a lot more GCCs into that automotive hub. So yes, we might see a little bit of this concentration around where the talent is. And that's not necessarily a bad thing. We want our talent to survive in India. We want our talent to flourish in India. And if GCCs become another recruitment grounds for our talent in that locality, then all the better.
Speaking of which, and this is your last question, let's just talk about a talent crunch, particularly in AI and data. So this coming from the Quest Corporation, saying that AI, getting talent that is skilled in AI and data continues to be a bit of a challenge. And there are cloud and infrastructure, for example, cybersecurity, platform engineering. These are all areas where there's a bit of a lack of skills. So what do you do about that? And could that be a bit of a restriction on the growth or the excitement about the demand for talent?
You're right. This is one of the bigger worries that executives in the GCC industry have, which is about the quality of talent that is coming from India. As of now, they are basically supplementing the talent that is coming in through their in-house training. But that is not a very scalable solution. While that will continue We as a nation and as an industry need to look at other solutions, whether it is about changing the way we nurture talent within our universities, whether it is about not looking at the GCC industry and the GSI industry as two separate options. There is a lot of this talent in the GSI industry, in the third-party outsourcing industry. Can there be partnerships that can be built in between them? The GCC industry is also actively looking at creating partnerships with universities today. And some of these innovative ways and new ways of working will need to be adopted by India to tide over this. This is a real concern, and we need to take steps to tide over this.
Absolutely. As the wave of AI continues and its growth continues, I'm sure you will. Thank you so much for that, Sumit Saragi from Oliver Wyman. Thank you. Okay, you can read more about this phenomenon in our Inside India newsletter this week. Become a subscriber to get more such insights into what is shaping the Indian economy. So we were just talking about this, Sumit and I. In 2024, over 70% of H-1B recipients were from India and about 12% were from China. Now, with tougher barriers, top talent is eyeing new pathways, building at home, shifting to other tech hubs, or rethinking global mobility completely. But many who've made the US home plan to stay. This weekend on CNBC explains why Indian and Chinese talent are rethinking the American dream. Here's a preview.
What if Elon Musk had been told, pay $100,000 or you can't work in the US? Or Jensen Huang, CEO of the world's most valuable company, Nvidia?
I don't think that my family would have been able to afford the $100,000. The opportunity for my family and for me to be here would not have been possible.
These tech leaders once held H-1B visas and went on to build companies worth hundreds of billions of dollars. Indian and Chinese engineers have long powered the US tech industry, with Amazon, Tata, Microsoft, Meta, Apple, and Google the top employers of H-1B visa recipients.
My prediction is this shock forced more startups to embrace the work from anywhere model. The loss will be of the American economy.
There are some top talents from Stanford University, from Google, or from Apple have come back to China, joined Baidu or other IT companies.
But policies don't just affect companies. They influence how workers think about their futures, whether to build a life in the US or to look elsewhere.
If that avenue is shut down by a significant degree, perhaps a lot of that talent is going to be staying and working in companies in India, in China, actually founding new tech companies there. That could really impact global tech competitiveness on a quite large scale.
You can watch the rest of that CNBC Explains episode on our website and our CNBC International YouTube channel. All right, Indian markets have joined the trading day, so we will look at some movers in Mumbai after a short break. We're back in 2. Stay with us. Well, it's shaping up for a weaker session if the early minutes are anything to go by. Indian markets coming online, and you can see the Nifty dropping about 0.5% from the get-go, falling below 25,400. This is after finishing the session 25,509 in the previous session. And you can see pretty much unchanged on that dollar-rupee rate. Elsewhere, let's look at some of the movers in the markets today. A quick check on shares of Ola Electric. The electric scooter maker has cut its revenue forecast as it shifts focus from volumes to profitability. Ola now expecting full-year revenue of 30 to 32 billion rupees. That is down sharply from its earlier 42 to 47 billion estimate. But it has maintained its full-year for 26 auto gross margin target of 40%. Profitability efforts, though, are showing early signs. Ola's auto unit reported its first positive EBITDA, helping narrow the group's Q2 net loss to 4.18 billion rupees. Costs also fell 44% after Ola switched to using its own battery cells. But the pivot has hit sales. Volumes nearly halved, and revenue slid 43% in the second quarter. That stock off more than 3%. Shares of Bajaj Housing Finance, those are also in focus this session. Intense competition in the high-end home loan market, causing the Indian NBFC to post its slowest profit growth since last year's September IPO. It was among the most successful listings of last year, debuting at a premium of more than 100% to its IPO price. Now, in the second quarter, the company is reporting a profit rise of 18% on the year. Remember, back in July, Bajaj Housing had warned of growing at a slower pace this year. The shares off just a fraction. Let's turn to telecom. We are also watching shares of Bharti Airtel. Bloomberg News is reporting that a unit of Singtel wants to sell 51 million shares in the Indian telecom major for around $1.1 billion. JP Morgan Chase and Company acting as the sole broker for the deal that's expected to take place today. The transaction is seen as part of Singtel's broader restructuring strategy to optimize its holdings in regional telecom ventures. Well, we want to take you for a quick check on the Kospi right now. There are some updates coming in that North Korea has fired a ballistic missile. The Japanese Prime Minister Sanae Takaichi has been commenting about it, indicating where it fell outside Japan's EEZ. The Kospi down more than 2.8%. We've got the US dollar up slightly against the Korean won, and we're going to be keeping an eye on the Nikkei today. Also, the Nikkei seeing sharp declines, down more than 2% in early trade here in Asia. All of this coming after a weaker performance on Wall Street as well, but we will keep an eye on that news coming out of South Korea. The military saying it has detected a ballistic missile fired by North Korea. Okay, back in the United States, the government shutdown continues. The FAA has ordered airlines to start cutting flight operations starting on Friday. Well, luckily for us, Monica Petrelli has the latest on this. I think it's always a bit of a worry when it gets to that stage where you've got to start cutting back flights.
Yes, exactly. So we had a preliminary list, but we've now got a confirmed list of the airports that will be subject to these cancellations. And the Trump administration saying it would release this list on Thursday, still Thursday in the U.S., and they did late in the evening. And then we can see that really some of the country's biggest and busiest airports are being affected, from the major airports servicing Los Angeles and New York to many of the big cities in between, including Hartsfield Jackson Airport, which is the busiest airport in the world in terms of passenger volume. Now, we can see as of 7 p.m. Eastern Standard Time, Cirium data showing about 524 flights have been canceled. That's only 2% of Friday's schedule. The Trump administration confirming it will rise to 4%. Only United currently showing 4% of flights canceled. So those flying American and Delta may want to check back. We're also seeing on a more limited basis cancellations coming from Southwest, Alaska Airlines and JetBlue. No indications, however, that international flights have been affected. We have received word of this from numerous airlines here in the region. But many of those regional flights, well, you need to check your schedule before you head to the airport.
Absolutely. So Monica, what happens if this government shutdown gets resolved? How quickly could flights come back?
Well, you know, this is different than weather, let's say, that just passes over. This is really, so it is said, there's a lot of infighting and finger pointing about what's really going on. But if this is truly a shortage of of workers. And this is also an issue of overworked people who have been working without pay and for overtime. And so we did see earlier this week the president of the Air Traffic Controllers Association telling CNBC that this would take weeks to resolve. Now, that puts us into Thanksgiving. That's a major travel period for the U.S. That's going to increase losses. So I think everybody is hoping for a quick resolution. But, you know, the U.S. is not the only country right now that is dealing with air traffic controller issues. Receiving word just earlier this hour, Delhi experiencing some issues due to what is called a technical glitch. They're apparently working on getting it back together and getting flights up and running. It is affecting multiple carriers, though, so we'll continue watching that.
I almost thought you were going to tell me it was the Delhi fog, which clears, but technical glitches. Let's wait and see what happens with that. Thank you, Monica. Okay, that is all that we have on the show for you today. Stay with us here on CNBC. Access Middle East will be up next.